Warren Buffett didn't become a billionaire overnight, and he certainly didn't do it by following flashy trends or chasing get-rich-quick schemes. No, he did something far more interesting, and believe it or not, it's something you and I can do too. Buffett's secret? It's simple, but it's not easy. It's about understanding one thing: the power of patience and consistency. Let's start with a story, one that takes us back to when Warren Buffett was just a kid. Picture this. Young Warren, only about 11 years old, bought his first stock. Yep, just 11. Most of us were busy trading baseball cards or maybe saving up for the latest toy. But Buffett? He was thinking long-term. He bought 3 shares of Citi Service preferred stock for $38 each. It wasn't a lot, but it was all the money he had. And what happened? The stock immediately dropped to $27. Ouch! Most people would panic, right? An 11-year-old kid might throw a tantrum, but not Warren. He held on tight, waited patiently, and sure enough, the stock climbed back up to $40. He sold it, made a tiny profit, and thought he was a genius. Here's where it gets interesting though. After Warren sold his shares, the stock continued to rise. It went up to over $200 a share. Can you imagine how he must have felt? He learned one of the most important lessons of his life right there: the value of patience. And this is where his secret begins. 1. The magic of compounding. Buffett likes to say that the most powerful force in the universe isn't gravity or nuclear power. It's compound interest. Think of it as interest earning interest. The more time you give your money, the more it grows, like a snowball rolling down a hill. This is what Buffett calls the snowball effect. You might be thinking, okay, sure, compound interest sounds nice, but I don't have millions of dollars to invest. Well, neither did Buffett when he started. In fact, his secret isn't about how much money you start with, it's about time and patience. The key here is to let your money grow slowly over time. Buffett once said, "I always knew I was going to be rich. I don't think I ever doubted it for a minute." And that confidence came from his understanding that wealth builds over decades, not days. 2. Don't follow the crowd now. Let's be real. If there's one thing that gets people in trouble when investing, it's herd mentality. You know how it goes. You hear about a hot new stock, everyone's talking about it. Your friend's friend made a killing on it, and before you know it, you're tempted to jump in. The fear of missing out is real. But Buffett? He does the exact opposite. Buffett is famous for saying, "Be fearful when others are greedy, and be greedy when others are fearful." What does that mean? It means that if everyone is rushing into a stock, it's probably overpriced. And if everyone is running for the hills, there might be a bargain waiting for you. Let's take an example from his own life. During the 2008 financial crisis, most people were terrified. Stocks were plummeting, and it felt like the sky was falling. But Buffett? He was buying. While others were panicking, he was swooping in, picking up shares of companies like Goldman Sachs and Bank of America at bargain prices. And here's the thing. He didn't buy them because he thought they'd go up tomorrow or next week. He bought them because he knew that in the long run, they would recover, and he'd make a fortune. And he was right. 3. Invest in what you understand. Now, Buffett isn't some sort of stock-picking wizard who knows about every industry under the sun. In fact, he's quite the opposite. He invests only in what he understands. If he doesn't get it, he stays away from it. Simple as that. Think about this. Buffett doesn't invest in technology stocks, despite the fact that tech companies are some of the biggest in the world. Why? Because he's the first to admit that he doesn't fully understand how they work. Instead, he sticks to businesses he can wrap his head around. For him, it's all about understanding the fundamentals. One of his most famous investments, Coca-Cola. Why? Because it's a product he understands. People are always going to drink Coca-Cola, whether the economy is booming or crashing. It's a solid business with a strong brand, and it's not going anywhere. In fact, Buffett loves Coke so much that he drinks it every day. Talk about putting your money where your mouth is. 4. The long game. Here's another thing about Buffett. He doesn't buy stocks with the intention of selling them next week or next month. He buys them with the intention of holding them forever. Seriously, forever. His philosophy is simple. Find a good company, invest in it, and let time do the work. If you constantly buy and sell, you'll end up losing money in fees and taxes. But if you hold on for the long term, you let the power of compounding and business growth work in your favor. One of Buffett's favorite examples of this is his investment in American Express. Back in the 1960s, American Express was in big trouble after a scandal rocked the company. The stock price plummeted, and people thought it might be done for. But Buffett saw an opportunity. He knew that despite the scandal, the core business was strong. People were still using their cards. So, he bought in when everyone else was selling. Today, American Express is one of Buffett's best-performing investments. He didn't panic during the scandal. He kept his cool, saw the bigger picture, and let time do its thing. 5. Don't obsess over the market. Now if you're thinking, okay, I get it, invest in good companies and be patient. But what about market crashes? What if the whole market tanks? Well, Buffett has an answer for that too. First, it's important to know that Buffett doesn't try to time the market. He's not checking stock prices every day or worrying about short-term dips. In fact, he said that he doesn't care if the stock market closes for 5 years. Why? Because if you're investing in a good company, you're betting on its long-term success, not on what the stock price does next week. Buffett once said, "The stock market is designed to transfer money from the active to the patient." And it's true. The more you trade, the more likely you are to make mistakes. Instead of worrying about what the market is doing day to day, Buffett focuses on the businesses he's invested in. He doesn't care about short-term fluctuations. He cares about the long-term growth of the companies. If the business is strong, the stock price will eventually follow. 6. Learn from your mistakes. Finally, Buffett's last secret to becoming a billionaire is this: learn from your mistakes. No one, not even Warren Buffett, gets it right 100% of the time. He's made his fair share of mistakes, but the key is that he learns from them. Remember that story about the city service stock he sold too early? That was a mistake, but it taught him a valuable lesson about patience. Later in his life, he made another mistake when he invested in a company called Dexter Shoes. It was a disaster, and he lost millions. But instead of beating himself up about it, he took responsibility and learned from it. Buffett once said, "In the business world, the rearview mirror is always clearer than the windshield." Meaning, you can't always predict what will happen, but you can always look back and learn. And there you have it, folks. Warren Buffett's secret to becoming a billionaire in any market. It's not about chasing trends or trying to get rich quick. It's about patience, understanding, and playing the long game. If you can do that, who knows? Maybe one day, you'll be the one people are asking for investment advice. Just remember, as Buffett himself would say, the stock market is a device for transferring money from the impatient to the patient. So, be patient, my friends, and let that snowball roll.